The August jobs report coming in better than expected, with 315,000 non-farm payrolls added during August. The unemployment rate also rose to 3.7%.
I look at these numbers as basically consistent with what had been expected. I think the market's still pricing in a reasonably good chance of a 75 basis point move. And overall, it was sort of, as your panel said, didn't move the markets one way or the other, which is, I think, right. But I wouldn't read a soft landing into these numbers just yet, because there's much more work to be done before we figure out whether or not the Fed gets inflation under control and avoids that bumpy land that people are worried about.
If there's a war, remember this is a year ago, that's when you get inflation expectations really taking off. Well, we got the war in Ukraine, and we also have a risk of instability elsewhere, not least Taiwan, between the US and China. So the ingredients of the 1970s are already in place.
We do think we're in a bottoming process. I know it's frustrating, and I've been in many of these markets. These are bear markets. Anything down more than 20% is a bear market. We also did not predict, no one did, the Russian invasion of Ukraine.
Cathie Wood comments, "We're at the bottom of the market right now. And one of the reasons is the ongoing Russian-Ukraine war, which has thrown global financial markets into severe turmoil and have driven inflation rates around the world to levels last seen in the 1970s. Now, yes, this scenario looks a bit like the 1970s, but we're sure it's not going to get worse than that. I mean, this war is lasting much longer than 1973. And we are already seeing double-digit inflation in the UK, where inflation soared to a 40-year high of 10.1%. And Fed hawkishness is making things even worse. Bitcoin has been closing down with 19K for the last few days. Financial and crypto market is literally in turmoil. In today's video, we will cover Cathie Wood, where she weighs in on the subject of jobs data, markets, and the Fed. Stay tuned till the end to know if this August job report could influence the Fed's next rate decision. And if you're new to my channel, be sure to subscribe to check back often for new insights and updates on the crypto, market, and economy. Let's get into the video.
We had a nice rally. Some were calling it a bear market rally. 23%, I think, on the S&P 500 from mid-June to mid-August. And now we're giving back. We thought one of the reasons for that rally was that the Fed was going to pivot, and that the market, seeing the deflation in the pipeline, assumed that the Fed would start talking about that deflation. Instead, we got Jackson Hole, and now the market's relapsing. Chairman Powell gave his annual presentation at Jackson Hole, or gave the Fed's annual presentation. And we read line by line what he said, and it was very interesting. He invoked the name of Volcker, former Federal Reserve Chairman Volcker, who really combated the inflation of the late 70s and early 80s. He invoked his name twice, but he also hinted by using the phrase "keep at it" or "keeping at it" twice. So that was really a reference to the late 70s, early 80s. And I really do believe that the Fed believes that we have a problem that might be that significant. We do think we're in a bottoming phase here, because we think we're going to see a lot of deflationary signals that will, at some point, get the Fed to talk about them. It doesn't want to talk too soon. It doesn't want to give anybody any indication that it's anywhere near pivoting. It wants to sound very hawkish, wants everyone to believe that they're going to be as tough as Volcker was, in order to get to 2% faster than would otherwise be the case.
Fed Chair Jerome Powell has made it clear, notably at a hawkish speech in Jackson Hole, that the central bank expects to impose further large rate hikes to try to tame inflation. Now, the economy gained 315,000 jobs in August, a still solid figure that pointed to an economy that remains resilient despite rising interest rates, high inflation, and sluggish consumer spending. Megan Green, chief economist at the Kroll Institute, also said that if the Fed were to design the job report, this is the kind of report they would have designed. So you see, the sun is still shining on the US labor market. But does that mean we can see a soft landing? Let's get into the video and hear what Cathie Wood has to say on this.
So the household, non-farm and payroll employment was roughly in line with consensus expectations, up 315,000. Household employment was up more than 400,000. Now, you know we pay more attention actually to the household. And if you look at household employment, it flattened out and actually went down from March until this month. And so from March through August, effectively, it's been flat with this latest 400,000 booster. But if you look inside the 440,000, what you're going to find is that's all part-time, much lower paying jobs. Full-time employment is down. And so that's a problem for the economy. It suggests stresses and strains, more people having to work 2 jobs to make ends meet and pay for food and energy. So that's a problem. And what's also interesting is if you look at the gap between the non-farm payroll employment number that seems to have been, charging ahead, and the household employment number that's gone flat, that's 1.6 million people right there. So there's a huge discrepancy between those 2 measures of employment.
Cathie Wood is more inclined to the household employment measure, as it includes many small businesses, and they often react much more quickly to changes in the economy than do large corporations, which are captured by more non-farm payrolls. The national labor force participation rate went up in August, and that's exactly what the Federal Reserve wants to see. Most people look for jobs in August, easing labor market pressures, but many have been laid off as well. Many big corporations have been laying off people lately, so what could this mean? Let's hear Cathie Wood's viewpoint on this matter.
The unemployment rate did go up from 3.5 to 3.7%. We did have an increase in the participation rate in the labor force, so that's maybe it certainly is one reason for it. The average hourly earnings were up 0.3%, and we now know that they peaked on a year-over-year basis at 5.6% in March. March is an important month here. It seems like a lot of things peaked back then. And now we're down to 5.2%. And still, that's a huge loss of purchasing power because inflation during this time was up, if you look at the CPI, which does include food and energy, up 8.5%. So, more than a 3% loss of purchasing power on a year-over-year basis. The other thing we saw was the average work week ticked down. Most people do not pay attention to this number. It just changes by a 1/10 or 2 per month, up or down. But it often has an outsized impact on average weekly earnings. So those are even worse because hours have ticked down. The other thing to note is that the Challenger survey, which measures layoffs, broad-based layoffs, those are up 30% year over year. This is what I mean. We're seeing all of these headlines, and the Challenger survey suggests they are real, and yet we're not seeing it in the employment report.
Job cuts in the United States observed a monthly decline of 21% to decrease from 25,810 recorded in July and reach 20,485 in August. But on an annual level, the figure rose by 30.3% compared to the same month in 2021. Cathie Wood believes not everything is as rosy as it seems. So that's it for today. How do you guys think this August job report could influence the Fed's next rate decision? Is August jobs report enough to please the Fed? Let me know your thoughts in the comments below. And for more videos on crypto, market, and economy, be sure to subscribe, like, and share. I'll see you guys in my next video. Adios, and thanks for watching.